China's treasury diversification and capital flow signals. Reports that Chinese regulators advise domestic financial institutions to limit exposure to US Treasuries also contributed to market sensitivity. While officials framed the guidance as risk diversification rather than loss of confidence in the US creditworthiness, markets interpret such signals strategically. If a major holder of government debt reduces purchases, yields could rise. Such rising yields can tighten financial conditions globally. Tightening conditions increase stress across markets, reinforcing demand for defensive assets like gold. This demonstrates how capital flows influence commodities directly. Precious metals are not only affected by supply and demand for jewelry or industrial use, but also by the global portfolio decision of sovereignty institutions. Japanese political stability and fiscal concerns. The political landscape in Japan adds another dimension. A decisive electoral victory for the ruling party claimed markets and boosted equities. However, proposed tax cuts without clear funding sources raises concerns about fiscal sustainability. Investors reached positively in the short term but remain cautious in the longer term. Fiscal uncertainty in major economies tend to support gold prices because it increases doubt about government balance sheets. Even when markets appear stable, unresolved fiscal question functions as latent risk. Geopolitical negotiations and military posturing. Diplomatic developments involving Iran and the United States also shape investor psychology. Reports of progress in nuclear talks suggest reduced immediate conflict risk. Yet continued sanctions and the military positioning indicate that tension persists. Markets interpret such situations as unresolved rather than resolved. In finance, unresolved tensions often produces more hedging activity than open conflict because uncertainty is harder to price than known outcomes. Gold benefits from this ambiguity because it serves insurance against escalation. Technical analysis and market threshold. From a technical perspective, traders monitor specific price levels that indicate momentum shifts. For gold, resistance near 5250 represents a threshold momentum shift. For pardon, whose represents a threshold whose breach could signal stronger bullish momentum, while support near 4423 marks a level below which bearish pressure could accelerate. Silver shows similar technical boundaries with resistance near $92 and support around 60. These levels function as psychological markers where large trading volumes tend to cluster. When prices approach them, volatility often increases as traders adjust positions. Technical ratings in mid-range suggest that momentum currently favors gold more than silver. This divergence is common because gold is primarily a monetary metal, while silver has significant industrial demand. Economic uncertainty tends to support gold first and silver later. Structural mechanics of the gold market. Understanding how gold is priced requires distinguishing between the spot market and the futures market. Gold, spot prices reflect immediate delivery transactions while future contracts determine prices for delivery at later dates. In practice, future markets often lead price discovery because they attract higher trading volume and speculative participation. Liquidity concentration in a particular futures contract, such as the December contract mentioned in report, can amplify price movement because large volumes pass through a single pricing channel. This structure means that short-term gold prices often reflect trading positions rather than physical supply conditions. The psychology of markets in multi-risk environment. The broader lesson from the current price movement is psychological rather than mechanical. Modern markets operate within a network of interconnected risks rather than isolated events. Investors assesses not only individual threats but also how those threats might interact. A modest geopolitical tension combined with uncertainty and uncertain monetary policy, speculative activity, and fiscal ambiguity can collectively produce stronger market reactions than any single factor alone. Gold and silver respond to this layered uncertainty because they are instruments of financial insurance. Historical context of precious metals during uncertainty. Throughout history, precious metals have surged during periods when traditional financial assets appeared vulnerable. During wars and currency crises and inflationary periods, gold often served as stabilizing reserve even in modern economies. Dominated by digital transactions and comparative derivatives, the funding logic remains unchanged. When trust declines, tangible assets gain appeal. The persistence of this matter across centuries reinforces gold's reputation as strategic hedge rather than merely a commodity. Short-term volatility is important to distinguish. The persistence of this matter across centuries reinforces gold's reputation as a strategic hedge rather than a commodity. Short-term volatility versus long-term trend. It is important to distinguish between short-term price swings and long-term structural demands. Short-term volatility often results from speculative flows, margin adjustments, and algorithmic trading. Long-term trends, however, depend on macroeconomic fundamentals such as global debt levels, currency stability, geopolitical alignment. The current environment contains elements that support both volatility and upward bias. Speculative activity produces rapid fluctuations, while structural uncertainty provides underlying support. Implications for investors and policymakers. For investors, rising precious metals prices signal a need to monitor systematic risk rather than simple commodity supply conditions. Metal markets often function as early warning indicators of broader financial stress for policymakers, such as price movements can reflect declining confidence in institutional stability because gold is often purchased when trust weakens. Persistence prices increase may indicate skepticism about monetary or fiscal credibility. Conclusion: Gold as a barometer of global anxiety. The recent gains in gold and silver illustrate how financial markets interpret the world's political and economic landscape. Prices are rising not because a single crisis has erupted, but because multiple unresolved tensions exist simultaneously. Speculative trading, institutional repositioning, economic data anticipation, global political negotiations, and capital flow adjustments all contribute to a climate of strategic uncertainty. In such an environment, investors seek assets that lie outside the structures they fear may destabilize. Gold and silver fulfill that role with unmatched historical precedent. Ultimately, the metals rally is less a story about commodities, more a story about confidence. When confidence in system weakens even slightly, capital gravitates towards assets that require no promises. Precious metals rise because they embody that absence of dependence. Their price is therefore not merely a number on a chart, but a reflection of collective perception about the stability of the world that they live in itself.